Volatility works both ways. People love volatility on the up, but when the volatility goes down, then that's where people get a little bit freaked out. So what we want to get into is looking at, all right, well, what should you do when volatility hits? And if you look at this screen here, this basically tells you why we even put up with volatility in the first place. Is that if we just kept our money in treasury bills, a growth of $1 doesn't really grow that much. But if we have large company stocks or small company stocks, value stocks, growth stocks, all stocks are not created equal. And if we take on a little bit more risk with these particular issues, guess what? You're going to get a higher expected rate of return, but it doesn't work in a straight line. You're going to have some ups and downs and volatility along the way. You just have to learn to control your overall discipline or learn or understand exactly what your portfolio is doing. And I think, Al, that's a big mistake that people make. They don't get that perspective. They don't understand really what their goals are, what rate of return that they're looking for, or how that portfolio actually should be built.
Yeah, and I think the other thing, Joe, is in periods of time like this where we've had a good bull market, a good bull run, so then it's like, what should we do? And the tendency is when the market is high like right now, maybe it's enough. Maybe we should get out. Maybe we should market time. And we know that when people market time, they don't necessarily pick the best times to get in and out. In fact, there's a Dalbar study that this is a couple years ago. This is the last 20 years. I think it's from to 2016. The S&P 500 earned 8.2% during that period of time, and the average equity investor earned 4.7%. So about half of the market. Why? Because we have a tendency, Joe, to get in and out of the market at the wrong times.
Well, I mean, because it's the volatility, right? As volatility goes up, it's like, hey, we feel comfortable. Look at my statements. I'm making a lot of money. But when volatility goes down, we get scared, especially as we get close to retirement. It's like, oh, wait a minute. I need to use this money. This needs to create an income stream. This needs to replace my paycheck. But the problem is that we forget what our time frames are. Our time frame is not our retirement date. Our time frame is rest of life. And for a lot of you watching this program right now, it's 10, 20, 30, 40 years, right? So you need equities in that overall portfolio to make sure that you outpace inflation and that money is going to be there for you 10 or 20 years from now. The biggest mistakes that we all make is that once we see that decline, we bail. We get the heck out of the overall markets. That's why most average investors completely underperform the market by half. The market does 10, we do 4. I mean, it's crazy. We have to learn what we're doing with our overall portfolios before we can be successful as investors.
And it's really controlling your emotions, right? Because when we take a look at a typical market cycle, we tend to buy when we're optimistic and when we feel elation. And that's usually when the market's already done pretty well. It's gone up quite a bit. Then we tend to sell when we're nervous or when we're fearful. And at that point, so now we're buying high and selling low and repeating. And it's not a good recipe for success.
I mean, if you think about it, we want to buy things on sale. And so when the market is down, all right, that means prices are low. That is when we want to buy. We all know this. It is common sense. It's like, yes, of course, if I want to buy a new suit, a new tie, some new golf clubs, I want to buy them on sale. But everything we do in the market is the exact opposite because we are so emotion driven when it comes to our money. I don't want to lose any money because we're twice as fearful to lose $1 than we are happy to gain $1. So if you understand your biases, you understand your emotions, you understand your goals, you're going to be a better investor.